I think what's really idiosyncratic with Japan right now is the fact that their 30-year bond is that yield is surging, right? And it's an interesting contrast because in the United States, for all the time we talk about the Fed, the chair, and inflation, and all this interest rate stuff, the reality is that rate volatility in the U.S. has been extraordinarily low, perhaps until last night there. And rate volatility overseas is doing, in Japan particularly, is doing very interesting things. I think so. What's happening is that we're kind of importing a little bit of rate volatility from Japan right now.
Paul, I got to impress Purves here because you got up so early to be with us. So I took the 40-year piece in Japan, quoted in yield, I figured it out in price, and I looked at a standard deviation study. And you and I know that 4 standard deviations is where things get exciting. Yeah. The price has gone 90-something to 83, and 4 standard deviations is only 1 point more. From 83 to 82 really begins to show the stress. Yeah. Does that matter to the global bond market that we're coming up on a 4 standard deviation move in some of this stuff?
Well, I think you're seeing a little bit of it. It matters a little bit right now to the global bond market. It's funny if you look at calculations of the term premium, right? For several years, that term premium for the U.S. Treasuries was extraordinarily low. At the same time, the Japanese and European yields were in negative territory. Now there's no more negative yielding debt. That's been the condition for a while now. And our term premium has been at a much higher elevated level. So we do have to, contextualize our treasury yields in a global in a global construct. We import and export interest rates just like other countries do. It is one big global bond market. But to get back to Tom's question, the question is how much does it really matter here, right? And I think right now Japan is clearly very important. Is it going to yank our 10-year up to 4.75%? I doubt it, but it's sort of a subtle underlying pressure there that will sort of ultimately, reinforce valuations for treasuries, on our side.
Well, boy, I mean, again, I've been sitting on a beach for a week. I come back, the 10-year U.S. Treasury, 4.29%.
Yeah,
what's going on there?
Paul. Did you see the 30-year bond?
Yeah, I know, the 30.
4.93. We're on the 5% watch.
We are.
It's a crisis.
And look at the, there's the big steepening yield curve. What do you make of the longer end of the U.S. curve here?
Well, look, I think there's been this tension for some time, really over the last year or so, that actually really started in September 24 with our cutting cycle, where we cut 50 basis points in September 24, and that marked the low in interest rates for that part of the curve. And so normally, when you start a cutting cycle, all interest rates tend to go lower, right? And in this case, it's sort of been the opposite. And I think there's this thing about the term premium, or the steepener, if you will, being sort of sticky, higher, longer. Why is that the case? Part of it is because we've been cutting into generally pretty good growth and pretty low unemployment and pretty resilient inflation. And I think part of it is back to our earlier discussion that we're importing some of this from other countries, for example, Japan, right? So the global bond market is kind of lifting our back end as well. I think that it does create a challenge. I do want to talk about rate volatility a little bit more, though, because I think it's important.
Wait, who's doing the interview?
Well, he's a pro.
Folks, Michael Purves with us across the nation right now, a clinic on rate volatility. And on YouTube, subscribe to Bloomberg podcast for our rate volatility interview. Go.
Look, it's a subtle thing, but the MOVE index is extraordinarily low right now, right? And if you look at the range of the 10-year Treasury yield over the last couple of months, that range is about 20 basis points. You take the highest point to the lowest point. You go back to 1980. That's the tightest range in the 40 plus years, right? So why is that the case when we have all this drama about who's going to run the Fed and all that kind of stuff? I think part of this goes back to the fact that if, let's say, we get a super dove in as a very dovish set of policies coming out of the Fed prospectively, well, that is offset by higher term premium. And it kind of tends to dull the overall volatility picture. Similarly, if we were get a more hawkish than expected Fed in the coming months, that would reduce the term premium there, given this sort of backdrop of sticky higher inflation north of 2.5%. and an economy that's still pretty good, and these foreign bond yields, right? So it's, but then keeping it in a very tight range, unusually tight range, it is breaking out literally just as we talk to higher levels. How much it breaks out, I think we'll have to see, because I think you have to get back to U.S. fundamentals too.
Michael, what are clients doing these days? I mean, we have the market futures down at 1.5%, Europe trading off over 1% here today. Geopolitical risk right back on the front burner, I guess. Are they buying risk? Are they buying protection? What are your clients doing?
They're buying risk, but they're very much, if you're an equity a fund, long short or long only, you are a stock picker right now more than ever, right? Implied correlations across the stock market are record lows. They're spiking right now, but off record lows there, and I think they're really being very sort of careful. I think the protection, in terms of hedging market risk, there's a lot of anxiety because we've had 3 amazing years. Maybe we'll have another good year, but people want to protect gains, after such a great run. It's hard, I think, with buying VIX calls or S&P puts, simply because the correlations across stocks are so low, and that tends to suppress movements in surges in the VIX. When you have, we step back, we have some level of monetary easing on top of fiscal easing. We're going to get stimulus just clocking in soon, on top of a pretty good economy, right, with this massive fixed asset boom there. And that's driving correlations low. So the violence within the market is within the market. It's rotation and all that there. So when you wake up on a Saturday morning and there's a Venezuela headline like we had a couple of weeks ago or whatnot, what I've been saying, if you want to hedge those kinds of risk, don't do it with VIX calls or S&P puts. Do it with long gold or gold in some form. Michael
Purves with the Source. We welcome you on the Eastern Seashore. Nathan Hager Radio, 99.1 FM Washington, 92.9 FM in Patriot Land. Bloomberg 1130 here in New York. Good morning. The way you listen to a Sirius XM channel 121, particularly across Canada. Stay warm out there. The cold coming for the next 15 days. We're efforting Rob Carolyn to give us historic perspective. Paul, like in 10 days, it's like the coldest I've ever seen in New York.
Yeah, it's going to get there. Yeah, and they got in the Midwest right now, they're getting hammered. So
are you surfing?
Yeah, exactly. No, stay close to home.
Michael Purves here, and let's talk, folks, basic equity market. I'm going to be filtering in, folks. I worked all weekend. The zeitgeist was just absolutely unreal. And just now, as an example, Adam Posen, Peterson Institute, Justin Lamond, I haven't read it yet. I'll not read it in French, Michael, excuse me. But Dr. Posen, Europe has crossed the Rubicon. Good. Here is a guideline for what to do now. I'll report on that in a moment. What it comes down to is, what do I do with my 401k given a cacophony of news flow? How do you distill President Trump zeitgeist, if you will, to an investment portfolio?
Well, I think this is sort of a tired cliche, but I think it does speak to diversification, right? If you diversified into European equities a year ago, right, you massively outperformed pretty much any part of the U.S. equity complex. They're probably not only in local terms, but particularly so in dollar terms there. And I think that's part of where, there's so many unknowns with respect to how all this geopolitical realignments are going to shake out. But if you step back, look, it's not just the U.S. economy that's doing pretty well. It's most economies in the world are doing remarkably well. I was talking to a friend of mine just yesterday about European exports, and he was like, European exports to the U.S. represent less than 3% of German GDP there. And so I think there's a lot of important things that are happening outside of the U.S. where there's really great opportunities, and particularly, if Europe really goes from, a narrative to actual action with respect to some of the stimulus in reaction to this geopolitical alignment, there's going to be a lot of great earnings growth there, and probably a strong sequel to last year's performance.